Hi guys, so this is the part 4 of the swing trading video series. In the first 3 parts we have seen about basics of swing trading, about support and resistance with respect to swing trading, and instrument selection, that is why stocks are the best way forward when it comes to swing trading, especially if you're a beginner. So in this particular part I'll be covering up the top-down approach, and part 5 would be about swing trading strategies. So let's get started.
In this channel, we talk about trading, investing, and market analysis to help you become a better investor and trader. So if you are new here, consider subscribing.
So the learning objectives for this part are as follows. So I'll be taking you through some basics of top-down approach first. Then I'll be showing you why top-down approach should be preferred over bottoms-up approach. Then I'll be showing you 2 concepts, that is one of mean reversion and trend following. And I'll be showing why you should align yourself with trend following, especially when you're trying to swing trade. Then I'll be taking you through a concept introduced by Jesse Livermore. That is a concept of sister stocks. This concept would be more relevant in the strategy section, but I'll show you some basics of this concepts in this part 4, so that when I introduce this concept later in part 5, you would know what this concept means. Then there are 3 specific points that I want to discuss about. It's more relevant to swing trading and sort of any sort of trading you want to do. The first point is that of importance of keeping a trading journal. In case you don't keep a trading journal, get into a habit of keeping one. Then I'll be showing you the right moment when you have to take a long trade or a short trade. I have covered this aspect in some of my videos, but I'll again repeat this because this is extremely important when it comes to success in swing trading. And then I'll be giving out 5 set of rules that you have to broadly follow, especially relevant to this swing trading series. So let's get started with top-down approach first. So in top-down approach, what we do is we start with the broader market, then we move to sector, then we move to stocks, and then we decide which strategy we have to apply. See, the thing is, you cannot have one strategy for all type of market conditions, which is why I have kept the strategy section towards the very end. It's going to be the part 5 of the strategy section of swing trading series is going to be many videos. I can't cover all strategies in one video, and I'll be precisely showing you how we would analyze the broader market, then the sector, then the specific stock, and then based on whatever underlying market condition exists, we'll be deciding which strategy to apply. So that is how we are going to proceed. So what we do in top-down approach is that we take a more holistic view of the market. We don't look at stocks individually. In a much more simpler language, if I want to explain, then top-down approach is about not seeing the stock on a standalone basis, but putting it into a context of overall market, right? So even if you see in terms of risk management or position sizing, a top-down approach is actually really helpful, because whenever you apply this top-down approach method and you arrive at a trade, you would know that you would be trading with the strongest or the weakest stocks. Now what I mean is, in case you're looking to go long, and after top-down analysis we come to a conclusion that this is a good time to go long in the market and not short, then you'll automatically be aligning with the strongest stocks. On the flip side, if you see that this is not the right time to go long and market is not that strong, then you'll automatically select the weakest stock, because that is how we proceed. We look for broader market trend, then we look for sector trend, and then we look for stock specific trend, right? So there are 2 points that I want to mention here. Because we are swing trading and we are not investing, which is why we don't hold our positions for more than few weeks to, let's say, a couple of months, which is why you don't need to go into in-depth macro analysis. By macro analysis, I mean don't get into studying too much about the economy, the various numbers that come out. That is irrelevant in swing trading. Similarly, there's no need to do any sort of micro analysis when it comes to individual stocks. The fundamental criteria that I gave out in part 3, those criteria are more than enough when it comes to selecting the right kind of stock. When we come to mean reversion or trend following, I'll be showing you why trend following is a better way to go about. And why mean reversion? Unless and until you get really experienced, you should be avoiding this mean reversion technique in swing trading. So we just focus on three main components: one, broader market trend; number two, sector trend; and number three, stock trend. Now these components would be understood well when we start with the strategy section, but because in the strategy section we have a lot of things to cover, which is why I'm explaining the top-down methodology in a separate video. So by broader market trend, what I mean is that we'll be analyzing the benchmark indices. In case you're trading in our markets, our benchmark index would be Nifty 50. For the US markets, it's S&P 500. For the German market, it's the DAX. And for the UK market, it is FTSE 100. Now, once we identify the broader market trend, then we would move to sector trend. We would suppose while doing broader market analysis, we come to a conclusion that trend is on the upside. Then we would be looking for only those sectors which are aligning with the broader market. And same observation holds true for stocks. So if broader market is up, we would like to see which sectors are up, and within those sectors, we would like to see which stocks are up, right? So this is how you will be aligning low risk trades which are of high probability nature. And make sure all the criteria that we discussed in part 3 are met, that is of volume, high beta, fundamentals, and institutional ownerships. Now, broader market trend can be analyzed in many ways, whether it is through moving averages or let's say indicator based trend identification techniques, or in case you're an Elliott wave trader, market profile trader, or Wyckoff cycle analysis trader, or there are Gann traders out there, or let's say neo waves. This is an extension of Elliott waves, I think. So there are many ways to analyze the broader market trend. You can you can choose your own method, but when I come to specific strategy section, I'll be precisely showing you how to identify broader market trend through various tools in case you don't have a particular method. So let me come to the concept of mean reversion and trend following. So I'll just cover mean reversion first. Now what mean reversion basically means is reverting back to mean. Now if you have some basics of statistics, you would know what mean means. If you don't, I'll just explain it. Let's assume this is the 200-day moving average and you see price coming close to this average, and then you see price moving away. Now what price has done here is that it has moved away from the mean, right? So mean here is the 200-day moving average, but mean can be anything. Mean can be a moving average or some valuation parameter or some indicator bands or some volume analysis volume analysis level that is determined. It can be anything, but in this specific example I've just taken up moving averages to explain this concept better. So in this case, what you see is price moved away from the mean. So what would mean reversion mean? It would mean that price would again revert back to the mean, and mean here is the moving average. So there are swing traders out there who like to participate in this move, right? Whenever price forms an excess and then it indicates, some indicators point that it would come down and the price retraces back to mean. So there are some really good traders who try to capitalize on these sort of mean reversions. I basically don't attempt this mean reversion trades because I'm a trend follower, and I truly believe in the concept that whenever price moves up, it can go to any level, which is why attempting a mean reversion trade is sort of difficult. I'll also point out to one thing that while you're following the trend, it is actually much easier to execute that even if you're a beginner. When it comes to mean reversion trade, you need more of skill and experience in order to trade this mean reversion, which is why I don't attempt it, because it's not to say that I don't have enough experience, but over the years what I figured out is that anticipating when the price would revert back to mean can sometimes lead to extremely costly mistakes, which is why I always align with the trend, and wherever the trend goes, I try to follow the trend in that direction. So the second method is that of trend following. Now what happens in trend following is that on a higher time frame chart, this is a weekly time frame chart, we just put a chart and see you have consistent higher highs and higher low forming. When you move to daily time frame chart, what we are attempting to do is we are attempting to capture these sort of swing moves which happen on the upside, which are broadly in the direction of trend. So I hope my point is clear. What we are doing again is we are trying to capture these swing moves which are in the direction of trend. So mean reversion actually is counter trend, that is against the trend, and trend following is actually in the direction of trend. So this is what I do for a living, that I simply trade the trend and I follow wherever the price goes. I don't attempt any sort of mean reversion trades. So while you're trend trading, the only thing that you require is immense discipline. But while you're trading the mean reversion technique, you need something more than discipline, that is a lot of skill and a lot of experience. So which is why even after spending so many years in the market, I don't attempt to trade this mean reversion technique. I simply follow the trend because that is more easy to do, and at least as a trader, psychologically I'm more comfortable in following the trend. So let me now come to the section of sister stocks. Now sister stocks was actually popularized by legendary trader Jesse Livermore. In case you haven't read books on this trader, please do so. You will get to learn a lot. So the basic idea behind this technique is that in case you identify some stock, let's say Yes Bank, right, belonging to the banking sector. So based on this methodology, what we do is, suppose Yes Bank is forming a nice pattern and you're getting a buy signal on it. So what you would do is you would try and look at Kotak Mahindra Bank or IndusInd Bank or HDFC Bank or Axis Bank to see whether similar patterns are forming on those charts or not. So in case similar patterns are forming, what you could assume is that the sister stocks of Yes Bank are actually confirming whatever is going on in the Yes Bank. So which is why that becomes a high probability trade. Always remember one thing, that in markets, money always flows in an entire sector or industry, depending obviously on the stock's performances. So if a particular stock is actually showing extremely bullish sign, it always helps if you check other stocks belonging to the same industry or sectors to see if other stocks are forming the same pattern or not. In case you find that other stocks are forming the same pattern, you know what, that becomes an extremely high probability trade or an investment, and you should pay attention to it. Now I don't want to go back way too much in time. Let us take IT example. It's a very recent example that is playing out. If you see, buying in IT sector has happened across the board, it's not selective. So what I have here is a 30-day return of IT stocks. So if you see, majority of IT stocks are actually heading higher. When you look at 1 year return, leaving aside Wipro, most of the IT stocks have actually moved up. Yes, individual performances do matter, and the net gain or net loss would depend on individual stocks, but look at broader trend. All IT stocks are heading up in one direction. This is what summarizes the concept of sister stocks. That is, we look at a stock, we see some pattern developing. If you want to buy that, look at stocks belonging to the same sector and same industry and see if similar sort of patterns are forming or not. In case you do see such patterns, definitely go and attempt that trade, because that becomes a high probability trade. So I hope my point is clear here. So the next important topic that I want to move on to is trading journal. Now trading journal is nothing but it's a document of what you are doing and what you were doing in the past and what you are likely to do in the future, right? So there's a very famous saying that what can be measured can be improved. Now what this means is that in case you're documenting all your trades and you're writing down your entry price, exit price, the risk per trade, your position size, your net profit in points and in percentage terms, then your profit and loss in terms of risk, that is R multiple. These sort of things actually, when you keep noting them consistently and you look at your journal 3 months down the line, 6 months down the line, you would know which are the area of concerns and where you have to improve. So I've just given a basic template of what a trading journal should look like. Don't start with a complicated journal. There are a lot of complicated journals on the internet. Just get hold of a very basic journal, or you can just use Microsoft Excel to make a journal that consists of only these points. Make sure you have the notes section. That is, after every trade you make a note on it and you see whether you have followed your rules or not. So in my trading journal, I have a fairly complicated trading journal because it consists of various trading methods. But in case you don't have a trading journal, do start with a very basic journal and sort of build on it as you mature in trading. So do define your profit and loss in terms of R multiple. Now I have explained R multiple in the Bank Nifty video. It is nothing but let's say you have 50,000 profit and you had a risk of 10,000 initially on a trade. What you need to do is you need to divide your profit or loss with the risk amount that you undertook in the first place. That is 50,000 in this case divided by 10,000. That would be your R multiple of 5. Now that's all you have to do. I've explained this R multiple later in the slides, so I'll go into the details when that section comes up. But as a word of advice, please do get into a habit of maintaining a trading journal. I can assure you one thing: if you haven't done this till now, and if you do this for the next few months, you'll automatically see your thinking process, and you'll see a lot of improvement that will gradually happen in your own trading method. So this is a part that I've covered in many videos of mine. What this is this is a Wyckoff market cycle. So initially what happens is price fluctuates in a range, that is accumulation, then price moves up, this is markup phase, then price again moves in a range, this is distribution, and then price moves away from this distribution range into a down move, which is called markdown phase. Now why this is important is because if you try to swing trade in a distribution phase or accumulation phase, you won't make any money. Rather, psychological damage in these sort of phases is much more, which is why you need to understand this market cycle. So in stage 1 accumulation phase, that is this phase, what usually happens is that price trades in a range, volume and turnover is on the lower side, and typically you don't see too much of range extension happening on the upside or on the downside. In the markup phase, what happens is volumes usually pick up. It's because price moves away from this range and you get some sort of momentum, which is why you see that turnover and volume improves. Stage 3 is actually the replica of stage 1, whereas again the volume dries down, the turnover is very low, price sort of fluctuates in a range, and in stage 4 again the expansion happens on the downside and volumes and turnover again improves. Now as a swing trader, do remember that your job is to participate only in stage 2 and stage 4. That is stage 2 and stage 4. So this is stage 1, stage 2, stage 3, stage 4. So your job, again I'll repeat, your job is to only participate in stage 2 and in stage 4. Right? Now from now on, do get into a habit of maintaining a separate watch list in your software of stage 2 and stage 4 stocks. Now the moment you start doing this, what you're actually doing is that out of a basket of many stocks, you're actually narrowing down stage 2 and stage 4 stocks. So when you conduct a top-down analysis and you find that broader market trend is up, you would immediately refer to the stage 2 watch list. And in case you do a top-down analysis and see that a broader market trend is down, sector trend is down, then you simply refer to the stage 4 watch list. Now, this is why it is extremely important that you follow this step. Number 1, participate only in stage 2 and stage 4. And number 2, start maintaining a separate watch list of stage 2 stocks and stage 4 stocks. So this is some data that I pulled out regarding swing moves in stage 2 and stage 4. So what we can see is that in phase 1 accumulation and phase 3 distribution phase, the average swing movement that happens in a stock is between 8% and 4%. Right? Now see what happens when a stock enters phase 2 and phase 4. The average move that happens is about 28%. So let me ask you a question. If you are a trader, do you want to target this move or you want to target this move? The answer is pretty simple, that you make money when stock moves, whether it is up or down, it does not matter, but you need that stock to move. Now in phase 1 and phase 3, stocks do not move, so there is no point trading these phases. You only have to participate in phase 2 and 4, which is why this Wyckoff model actually becomes extremely useful. I've covered this model in trading, in investment, in many of my market analysis videos as well, and which is why I've come back to this model, because keeping this point in mind, that phase 2 and phase 4 are the only times that you'll participate in the market, will save you from a lot of whipsaws that typically happen in phase 1 and phase 3. So I hope my point is clear. So in the next section, we are going to cover some rules. So I've laid out 5 rules that you have to broadly follow in swing trading. So I'll just start with rule first. The rule first is about planning your trade. So whenever we finish the part 5 of swing trading series, what you need to do is you need to identify which strategy or which market condition appeals to you the most, and then you have to adapt that strategy according to your own psychological fit as a trader. Now what you need to do is you need to have a detailed document. You need to type this document, and you have to include your entry, exit, risk and stop loss that should be clearly defined. Then I would suggest that you just take a printout of this and you refer to it at least on a weekly basis. In case you find that you have really followed all the rules, do congratulate yourself, because this is a important step. What usually happens is that our human mind has 2 components. One is when we are awake, and the second component is the subconscious component. Now what usually happens is whatever we are in the real world is actually a reflection of what we think in our subconscious mind, and this particularly applies to trading. So which is why I always encourage that you should have a proper documented trading plan ready, and you should be reading it every week so that that plan actually becomes a part of your subconscious mind. So whenever you see something terrible happening in the market, your subconscious mind would kick in, and it would actually make you act in a more rational manner. Now you won't understand this clearly until and unless you implement it and you see the benefit of it playing out in real time. If you ask most of the successful traders, they follow this with great amount of discipline, that a trading plan should always be ready and it should be at your desk in case you want to take this as your full-time profession. So in my opinion, when it comes to the preparation aspect, your trading plan is actually the most important document that you have that would determine whether you would succeed or fail as a trader. So the part 5 of the swing trading video series would actually contain more rules which are more specific to the strategy that would be discussed. But these 5 rules that I'm going to show you, these actually broadly apply to all sort of trading techniques that you want to implement. So the rule 2 is always follow the leaders. That is what we have seen in this top-down approach. We need to identify which sectors are leading, and within those sectors we need to see which stocks are leading. And do remember one thing, that both stock and the sector should be in stage 2 or stage 4. I'll again repeat this, that if you have to become successful as a swing trader, do not underestimate the importance of stage 2 or stage 4 within a stock cycle or a broader market cycle as well. Rule 3 would be to always keep your risk in check. Risk per trade that you define should not be greater than 1%. As you gain more and more experience, you can switch from 1 to 1.5% or 2%. But this 1% rule is widely followed by some of the best traders in the world, and I don't see why this should be changed. Always get into a habit of noting down your profit and loss in terms of risk multiple. So I just briefly touched on this topic of risk multiple earlier. So I'll just explain it here. So in case your risk was 10,000 on a particular trade and your profit was 40,000, the R multiple for trade would be profit divided by risk, that is 4. So your aim is to always keep R multiple in your favor, which means that when you lose or when a trade goes against you, you should not be losing more than 1 R or 1.5 R. But when you win, make sure you're winning at least 4 times the amount you're risking, or 5 times, 6 times, the higher the better, right? So the rule 4 would be about emotions, your trading journal, and diversification. Now, broadly, it's agreed that discipline is actually the key to success in trading and in life as well. If you see most of the people who are extremely healthy, they'll be extremely disciplined in terms of what they eat, their exercise regime, their discipline in order to stay happy. Now that is again an important aspect. But the important thing that comes, whether it's in your relationship or your health or any other aspect, including trading and investing, is discipline. The most successful people in their fields are extremely disciplined. Now that sort of discipline you have to bring in your trading, which is why the whole importance of trading plan comes into the picture, because this is the document that would motivate you to remain highly disciplined in trading, right? So about diversification, what I mean is that there will be some situations where you will find that 2-3 stocks of same sector look extremely promising. Now you shouldn't be taking trades from the similar sector, because obviously risk always exists in all sectors. So what you need to find is the second best performing sector, and if you see a trade developing in that sector, that is the second sector, you should rather choose the trade from second sector rather than choosing 2 or 3 stocks from the same sector. So you can take a trade from sector 1 and take one trade from sector 2, but do not take both the trades from sector 1 or sector 2. I hope my point is clear. And trading journal aspect I've already covered, this is so important that I dedicated a slide to it. That trading journal is a document that will decide from this point onwards whether you are going to be successful or not. So do review it every week, make notes. Don't be afraid of admitting that you were wrong in a particular day or a particular trade, but try and improve on it, right? So the rule 5 is also extremely psychological in nature and more related to your subconscious mind. That is the art of disassociation and visualization. Now you would have seen that many successful people, whether it is sports persons or in any field, they would have spoken about this concept of visualization. Now visualization is nothing but mentally rehearsing number of scenarios that play out in the market. I'll just give you one small example. So let's say I have a long trade in Nifty or Bank Nifty. What I do is every morning before the market starts, I visualize worst case scenarios playing out in market, and then I visualize how I will be reacting to those scenarios. Now when you start imagining those things, there is a sort of mental images that are stored in your mind. Now when in reality those situations play out, you will automatically get into a habit of acting the way you have imagined yourself to behave in that particular situation. Now this is what visualization is all about. It is about going in future. It's sort of meditation where you go into the future and visualize how you will be reacting to certain situations, and that in turn trains your subconscious mind to actually act in a more rational manner whenever something untoward happens, that is in markets, right? The art of dissociation is actually taking a break when market is over. Now what happens is when our market closes at 3:30, traders start tracking SGX Nifty, or let's say Nifty futures, just to determine what is going to happen the next day. You know what the irony is, that at 3:30 your market is closed. There is nothing you can do about your position, or you don't have any control over the market. Now anything that you would do would only be at 9:15 a.m. the next morning. So which is why you don't need to spend the entire time after 3:30 rehearsing, or rather living in an anxious state with respect to what would happen tomorrow, which is why you need to learn the art of disassociating yourself from the market once it shuts down. You have to mentally switch off, enjoy your life. If you start to follow these things, that you go into a state of mind where you're more relaxed, you enjoy your life more, you will automatically see that your trading starts to improve over a duration of few months. Now, this might sound strange, but just practice it and see whether it is visualization, trading journal, or the art of sort of disassociating yourself from the market. Now, once the market ends at 3:30, I don't look at futures, I don't look at anything, because I don't have any control over anything that will happen tomorrow. So at 9:15 a.m., whatever happens before that, 1 hour before that, you just practice the art of visualization, that what you would do in case you're seeing in the morning that market is going to open against your position. Just imagine yourself being calm and execute your plan well. And when that situation comes, you would automatically see that you would be performing much better than you were performing in the past. So how we proceed from here? Now we have covered part 1, part 2, basics of swing trading, and in part 2 I had specifically taken up support and resistance. Now part 3 was about instrument selection, and this part 4 was about introduction of top-down approach. And I also wanted to talk about some psychological aspects of trading, which is why again this video is fairly long. The part 5 of swing trading would be an ongoing topic. That is, whenever the part 5 comes out, it would be actually divided into many sub parts, because I'll be covering a lot of strategies. Now, when I begin part 5, I would be starting another topic as well, because let's say I'm planning to make about 10 videos on swing trading strategies. I would space out those 10 videos over the next few months while I cover some other topic as well. So I'll just sum up the key points. The next topic of swing trading strategies, I'll be releasing the first one next week. There are just 2 points that I'll repeat again. One is trading journal. Don't underestimate the importance of trading journal. And second one is start getting into a habit of mentally preparing yourself for your trades, and overall how you should approach trading. Stage 2 and stage 4, again, as a swing trader or as an investor, these 2 stages are the stages where you make money or you save money. So again, try and focus on these. So that's all for this week in the swing trading series. In case you have any doubt, just leave a comment below and I'll get back to you as soon as possible. And thanks a lot for watching this video. Take care, guys.
Click on the subscribe button and bell icon to get instantly notified when a new video is uploaded. Thank you for subscribing.